Hi, I'm Michael Davin from the Department of Accounting. Today I want to talk to you about accrual accounting and cash accounting. Cash accounting is relatively straightforward. It's not hard to count physical cash or to see how much money is in a bank account. That cash is important is obvious, but to really understand what's going on in a business, we need to pay attention to economic resources beyond just cash. That's where accrual accounting comes into play. Accounting exists to inform and enable decision-making. It does so by describing the economic activities of a business, the stocks and flows of the economic resources of the business. Describing these stocks and flows is where judgment comes into the practice of accounting. So let's get into that practice. This is Barry the barista, owner and operator of a local coffee shop, Barry's Barista Bar, or BBB. Let's see how accrual accounting works at BBB. So what are some of the economic resources at BBB that accrual accounting seeks to describe? Obviously there's cash. The cash in the shop's register and bank account are examples of stocks of economic resources. The cash that a customer pays to purchase a coffee is an example of a flow. Similarly, we have the stocks and flows of the ingredients that Barry uses to make his great tasting coffee. When we look at Barry's beloved coffee machine, the picture gets trickier. This is an example of a stock. There is a future economic benefit in the coffee machine as it can be used for many years to make coffee. But there's also a flow when the equipment is used to make a cup of coffee, and not just the flow of coffee. There is the flow associated with using up some of this future economic benefit. Eventually, the coffee machine will no longer be adequate. Much of its economic benefit will have been used in producing thousands upon thousands of cups of coffee, and so we recognise an outflow. We call this depreciation, but more on that another day. Adding even more complexity, consider resources like BBB's employees or reputation. Clearly, these provide an economic benefit. They help in selling coffee. But how do we describe the stock and flow of such resources? Intangible economic resources like reputation are challenging for accrual accounting, and how best to deal with them is a subject of ongoing research. Cash accounting is simpler, so why can't we just focus on cash? Accounting only for cash gives a distorted picture of the business. We may see lots of cash coming in as Barry sells coffee and think the business is doing really well. But what about the money owed to suppliers, or the wages due to employees, or the use of the expensive coffee machine, among all the other resource stocks and flows? Accrual accounting, by contrast, describes the stocks and flows of economic resources in a given period, even if the associated cash flow happens in a different period. Timing differences between cash flows and the recognition and measurement of the associated non-cash resource flows often requires judgment. But these judgments help make accrual accounting more informative. For example, it can inform Barry about when to order new ingredients, or how many cups of coffee he needs to sell to make a profit in a given period. This is why we need accrual accounting, with all its judgments. We also need some guiding principles to help us with those judgments. Two fundamental characteristics we want from accounting information are relevance and faithful representation. Of course, we want relevant information that has the capacity to influence decisions. This influence may be in making predictions, such as using current earnings to predict future cash flows that a business might generate. Alternatively, relevant information might influence decisions by providing confirmation or evaluations of past performance and predictions. We also want information we can rely on and trust. A faithful representation. We are building a picture, a representation of the economic activities of a business. To be faithful, it needs to be complete, neutral, and free from error. This is more than just adherence to rules or ensuring accuracy or reliability of information. It is an ideal, an elusive ideal, since accounting involves judgment, and so a perfectly faithful representation is unattainable. Both relevance and faithful representation are topics of ongoing research to improve accounting practice. So let's explore the differences between accrual accounting and cash accounting in terms of these two characteristics. In terms of faithful representation, accrual accounting provides a more complete picture, but as it entails judgment, there is greater potential for bias or error to arise. Cash accounting has less scope for bias or error, but the picture of the business it provides is incomplete. In terms of relevance, cash accounting can inform short-term operational decisions. If a business doesn't have cash coming in, it isn't going to survive beyond the short term, no matter how profitable it may be. Accrual accounting informs a more comprehensive assessment of whether the business is profitable and what it is worth. Consequently, it informs future decision making from the strategic down to the operational level. Of course, cash is an economic resource, so accrual accounting captures everything that cash accounting does and more. Let's examine accrual accounting's description of the stocks and flows of economic resources in more depth. Since economic resources have to come from somewhere, we can see that the stock of resources controlled by a business has to be matched by a stock of claims against those resources. We call the resources controlled assets. Two types of parties make claims against the resources of the business: creditors and owners. Creditors are those owed economic resources by the business, and their claims are called liabilities. To the extent that the resources controlled, the assets, are greater than the claims by the creditors, the liabilities, the owners have a residual claim, which is called equity. Flows are represented as changes in assets, liabilities, and equity, with the changes in equity being further broken down into income and expenses. This relationship between assets, liabilities, and equity is the accounting equation. Accrual accounting is more informative as to the economic activities of a business. It can be both more relevant, useful for decision making, and a more faithful representation, more complete. For example, it can track the loan from the bank which Barry used to buy the coffee machine, an increase in assets, the coffee machine, and an increase in liabilities, the loan. It can track the sale of a cup of coffee, the increase in assets when the customer pays for the coffee, and the corresponding income or increase in equity, and the decrease in assets from the ingredients and equipment used to make the coffee, the corresponding expense or decrease in equity. Consequently, we can see whether Barry has made a profit, income less expenses, on that given cup of coffee, not just the cash flow that has occurred. In short, we need to move beyond cash to accrual accounting.